Everyone wants to reach financial independence before 40, but most people spend their time chasing speculative crypto coins, timing viral tech trends, or climbing a corporate ladder that is constantly collapsing. When those speculative bubbles burst, 99% of average investors are caught in the chaos. They lose control and watch their financial future evaporate in the panic. The actual blueprint for retiring early looks nothing like a chaotic trading floor. It is a strategy used by the quietest, most successful wealth builders, and it is so predictable it borders on boring. Achieving financial freedom is about removing yourself from the noise of the crowd and ignoring the high-risk tricks that lure in the masses. David is 24 years old and works as a database administrator. He doesn't have an Ivy League degree or a trust fund, and he makes a median salary of $55,000 a year. After taxes, rent, and basic living expenses, David has a modest surplus of just $800 a month. While his peers are stuck on a flat baseline, grinding toward a standard retirement at age 65, David's modest monthly surplus puts him on track to retire a full decade early. David's advantage comes from a psychological blind spot, one that remains invisible to the people around him. Legendary investor Benjamin Graham suggested we stop viewing the global economy as a rational machine, and instead imagine it as an erratic, manic-depressive neighbor named Mr. Market. Mr. Market is sometimes wildly optimistic, offering shares at absurdly high prices. Other days he panics and begs you to take those assets for pennies. Average investors let these emotions dictate their decisions, buying at the peak, then panicking and selling at the bottom. Viewing the market as an irrational opponent rather than an authority allows you to observe its tantrums and wait for the inevitable mistakes. David ignores the lifestyle inflation of his peers. He lives on 70% of his income, keeping his expenses flat while his coworkers upgrade to brand new SUVs. His strategy is mechanical, dividing his monthly surplus into two strict buckets. Bucket A is an automated monthly investment into an index fund for long-term growth. Bucket B holds dry powder, liquid cash in a high-yield account, waiting for a market crash to provide opportunity. This builds the mindset of a predator waiting in the tall grass, watching the markets with total patience for the exact conditions needed to strike. In this framework, cash serves as a weapon of readiness, held in reserve while the rest of the world's liquid savings are slowly eroded by inflation. Eventually, the economy hits a rough patch. Inflation soars, terrifying headlines dominate the news, and the stock market plunges 30% in a matter of weeks. People panic. They log into their retirement accounts and frantically liquidate their holdings to save whatever they have left. But David sees Mr. Market's depressive episode for what it is, a chance to buy shares of the world's most profitable companies at a 40% discount. While others flee, David remains unflappable. He opens his reserve and deploys his dry powder to buy up those heavily discounted assets at the rock bottom. This opportunistic move turns years of quiet, boring preparation into a sudden leap in net worth, drastically accelerating David's path to freedom. True financial independence doesn't require you to predict the complex, unknowable future of the global economy. Success is found by recognizing and patiently exploiting the inevitable cycles of human irrationality. By automating a boring baseline and keeping your dry powder ready, you transform terrifying market crashes into the greatest wealth-building opportunities of your life.